when the crisis unfolded and you found yourself broke, did you lose any of your real estate?
I lost it all. I
You
lost my
lost it
home. I
all.
lost my cars. I lost every.
Wow.
When I tell people how bad it was, Mike, people don't believe how bad it was. I was this close from being homeless. Gold people do not understand real estate, and the real estate people do not understand gold. And when you put those two together, gold preserves your purchasing power, and real estate helps you benefit from inflation driven by credit markets. You just need to make sure that when you're on the real estate side, before the credit market breaks, you convert that equity into something more resilient, which is gold. And that's the part that people miss. And if I would have done that, in 2008, just taken a portion, I mean, a small portion, 20% of the equity that I had on my real estate and just put it into gold, to your point, Mike, when the real estate market crashed, and it crashed because the credit markets broke, the gold would have accelerated against the real estate. And I easily could have gone back and bought everything I lost and more, and ended up with a lot more real assets on my balance sheet. But I was wrong footed. I didn't know how to play that game. And so I was on the wrong end of that deal.
Hi, this is Mike Maloney, and my guest today is Russ Gray. Russ, how are you doing?
Good, Mike. Great to be here.
Great. Russ is one of the original real estate guys. They started their radio channel back in the late 90s, and he
1997.
1997. And he has a great personal story that is going to help you navigate this coming economic disaster that is headed right at us right now. And he's got some great insights, and he has learned through experience. So, Russ, tell us your story with like the beginning of the real estate guys and everything, and up through the pain that you went through, the fire you went through to learn how you're going to navigate it this time.
Yeah, it's a long history, and I'll just give you the nickel tour. I saw that the baby boomer generation was moving into the asset allocation model where they were going to start making a move into bonds. So I thought I was fairly sophisticated back then, and I wasn't. This was in the 90s, and so I decided to get into the mortgage business in 2000. And I got into the mortgage business. It was a fantastic time to get into the mortgage business. I started a mortgage company. I covered everything. I bought real estate everywhere, and I was riding a bubble. I didn't know it. Thought I was a genius. Didn't understand really much past the treasuries, what the bond market even was or how it worked. And so I was generating a lot of income off of my mortgage business, and I was deploying that with a lot of negative cash flow real estate that I was candidly, in hindsight, speculating on. And what I didn't realize was that that equity is fake. And I think that when the tide went out, as Warren Buffett said, you get a chance to see who's swimming naked. I was one of those guys that was swimming naked. And our mutual friend, Robert Kiyosaki and Kenny McElroy, they were telling me, hey, guys, this is going to be a problem. And cash flow is really what you need to focus on and not capital gains. And, we were all equity all the time. And anyway, long story short is it blew up. And so when the credit markets broke and all the equity came out of the properties, I went from on an assets minus liabilities net worth being a multimillionaire to being broke. And what I didn't have was passive income because I made my living brokering credit. And when the credit markets broke, I didn't have anything to sell. And I didn't have any cash in the bank to go scoop up all the bargains that were everywhere because I didn't believe in having idle cash. I put it out to work all the time. And when the credit markets took away all my credit lines, even though I hadn't defaulted on anything, everybody was just shutting credit off to mitigate their own risk in what they saw coming. It was a sign. I mean, by the way, when you start to see companies curtailing credit, they're seeing weakness on the horizon. Well, I couldn't read those tea leaves back then. So now I had no cash. I had no cash flow. I had negative equity. I couldn't sell my properties. I had lenders after me. And it was just an absolute disaster. And so that's kind of the first part of the story. And then on the back end of it, I started looking at what was doing well. And the irony was at the same time real estate values were crashing, gold, which I wasn't into, didn't understand, was spiking. And I go, I don't know that correlation is causation, but there's something there worth investigating. And that's where I really started looking into gold and trying to understand what gold was. And in the postmortem of all that, I also did a deep dive into understanding what the bond market was and its role in what happened. And then I started realizing that when you put all those things together, there was really a better way to have approached that bubble. And I said, you know what? If this ever happens again, I'm not going to be wrong-footed like I was. I'm going to be right-footed. I'm going to do it differently, and that's what I've done. And I think now today, as we stand here on the cusp of what could be another bubble implosion in all kinds of asset price values, as the Fed has hiked interest rates, and I'm sure we'll have something to talk about that. I feel like I'm in a lot better shape to weather that storm now.
Yeah. So when the crisis unfolded and you found yourself broke, did you lose any of your real estate?
I lost it all. I
You
lost my
lost it
home. I
all.
lost my cars. I lost everything.
Wow.
When I tell people how bad it was, Mike, people don't believe how bad it was. I was this close from being homeless. And we stayed on the
Wow.
radio and we plowed through it and we continued to work. And I had an experience. My father was a high tech entrepreneur in Silicon Valley, and he lost everything in the 1987 stock market crash. And I was actually selling securities at the time, and I quit because I realized I was selling snake oil that I didn't understand, and those markets were casinos, and I was doing a
Mhm.
disservice to Main Street. So I quit. And I went back into corporate sales and started trying to understand, and then what was going on, and I wanted to be in financial services and financial education, but I didn't want to be in paper assets. And so I learned, though, when my dad lost everything, that you can have your net worth conflated with your self worth or vice versa.
Mhm.
And I saw that happen to him. And I said, if I ever get wiped out, I'm not going to stop believing in myself. I'm going to recognize it for what it is, which is a fantastic lesson. I'll tell you a quick story on that, too, by the way. Had a chance to interview Donald Trump before he was even a presidential candidate back in 2015. And I ended
Mhm.
up in the press room with him in Iowa. And I asked him, Mr. Trump, if you decide to run for president, you've had good times, you've had bad times. What did you learn in the good times? What did you learn in the bad times? And if you decide to run for president, how is that going to help you? Well, he didn't answer the last question because he didn't want to tip his hand. At that point, he hadn't announced. And he said to me, well, I didn't really learn anything in the good times. But in the bad times, I learned it's always good to have a little cash. And I've always told that story like the idea of having some cash on hand, having some liquidity would be a good idea. This is a guy who had negative net worth of almost $1 billion, a real estate guy with a negative net worth of $1 billion. So when he said it, I mean, my problem was a lot smaller, but I understood what he was saying. But the real wisdom in it was that he said he didn't learn anything in the good times. And so the
Huh.
inverse of that is that you learn everything in the bad times. And I thought, well, I just went through a terrible time in 2008. I must be brilliant, or at least there's a lot of brilliance here to be learned if I will do the work. So, and I have, I feel like I have, and I'm not saying I've got it
Yeah.
all figured out, but I scaled up the people I hang out with. I hang out with some pretty smart people, no
Uh-huh.
longer the smartest guy in the room. And I dug
Well,
deep into finding out what happened and why.
you said that you thought you were a genius when this was all when everything was on the way up, the good times,
That's
and
right.
so, so it's like the dummies come out of the woodwork in the good times, and they're not learning anything. Right? It's the tough times that really, and it's a shame that so many people have to learn from a lot of pain. I mean, and what you went through sounds like the ultimate. Just you know, it's being tested by fire, and you learn a maximum amount when you go through something like that, and you're much more cautious the next time around. So I've got a couple of charts that I want to show you, and the first one, we were both at a function recently called the Collective that was a bunch of very high net worth real estate investors. And one of the things that I have noticed is I've been presenting how much real estate is currently overvalued, but it's overvalued at the same time that the stock market is overvalued and at the same time that bonds are overvalued. So this is different than the crash in 2000. It's different than the crash in 2008, where it was real estate and the stock market. This time it's real estate, stocks, and bonds. And there are cracks in the foundation of the economy that are just enormous. And so the instability this time around is, I believe we're headed for an economic disaster far greater than 2008. But here we have when gold bottomed in 2001 at $256 an ounce, I think it was. The performance, gold and Robert Shiller's 20 city composite home price index. So gold and residential real estate here index to a value of 100. And you can see that they were both climbing up until 2006. Real estate leveled off, and then in 2007 starts to implode. And but gold, when you were talking with me at the collective, you were saying how it was reversely correlated. And here, gold did its job. It protected people. What's your comments on this? And what is your strategy today?
Yeah, such a great question, and probably the crux of the whole conversation. I think the first thing you have to understand is that when you think of the world in terms of dollars and everything is dollar denominated, you're automatically going to have a distorted view of value. In other words, if you have a $50,000 house, a 3-bedroom, 2-bath house that you buy for $50,000, and it's 1,500 square feet on a postage stamp lot in Main Street, America, and 10 years later it's worth 100, and then 10 years after that it's worth 200, or whatever number it is, at the end of the day, it still only sleeps 3 people. So in terms of real value, it never changed. What happened is either the dollar weakened against it, or they dragged purchasing power from the future into the present to bid it up. And every time anybody tries to make something more affordable by adding financing, they make it more expensive. And so when you understand those basic concepts, you realize that certain asset values are driven by healthy credit markets. And when credit markets break for whatever reason, and clearly that's what happened in 2008, the asset values that were dependent upon that healthy influx of credit collapse. And you can see it right there in the chart. But gold isn't in that camp. The other thing is, when you denominate in gold and not dollars, you're denominating in real money. And I learned that there's a difference between capital, money, and currency. And it took me a while to understand the differences. And when people think they're saving money, a lot of times they're really saving currency. And then sometimes people think they're making money or they're capitalists, but really they're financialists. And they're just generating paper profits, and they're collecting pieces of paper, and they haven't really produced anything of real value in the real world, which is true capitalism. So when I look at this chart, all I do is see that gold, measured in dollars. Well, this is real estate, right? So what I see is
blue is real estate, and the gold line is gold.
Yeah. So gold just continued to reflect, and this is denominated in dollars, right?
It's all denominated in dollars, and then it's indexed to 100. So it's the performance.
Okay. So the credit came out.
Up by a
the
factor
gap
of
is the
5.
credit came out.
Yeah. Here's one that you're going to love, because this next one, I've taken the real estate from its high just before the collapse, and I've priced it in gold. So this would be, and it's indexed to a value of 1. And what you see here is that the value of the real estate measured in gold, not the price, fell by about 85%. So at 80%, it means that if you had sold a home in 2005 and bought gold, and then sold your gold in 2012, you could have bought 5 of the same exact home. A 5 times increase in true wealth. And so this was the value of real estate measured in gold at that time, not measured in US dollars.
Yeah. And the nuance here is that you can see from the left-hand side of the chart, as the credit markets were breaking, which led to the 2008 financial collapse, the prices were coming out of real estate. Gold wasn't subject to that because gold is not part of the credit system. And so it was immune to it. That's why you buy it. It insures you. Some people think it insures you from a currency collapse, but it really insures you from a credit collapse. And what I've noticed is that when the credit markets break, gold does well. And so real estate doesn't. So you have to understand that relationship. And so the key is, how do you use real estate to create equity and then convert it quickly into gold? And to your point, then once your equity that you created in real estate, using leverage and inflation to your benefit when it's there, and then when the credit markets inevitably break because there's cycles, you have removed your equity and converted it into something more resilient, more real, which is gold. And that's where debt, real estate, and gold all work together. And this is the thing that I found a lot of people in either camp don't understand. The gold people do not understand real estate, and the real estate people do not understand gold. And when you put those two together, gold preserves your purchasing power, and real estate helps you benefit from inflation driven by credit markets. You just need to make sure that when you're on the real estate side, before the credit market breaks, you convert that equity into something more resilient, which is gold. And that's the part that people miss. And if I would have done that in 2008, just taken a portion, I mean, a small portion, 20% of the equity that I had on my real estate, and just put it into gold, to your point, Mike, when the real estate market crashed, and it crashed because the credit markets broke, the gold would have accelerated against the real estate. And I easily could have gone back and bought everything I lost and more, and ended up with a lot more real assets on my balance sheet. But I was wrong-footed. I didn't know how to play that game. And so I was on the wrong end of that deal.
Well, you probably wouldn't have lost your real estate. So you're saying pull some equity out of the house, refinance, take that and buy gold. And what happens here is, when the real estate crashed, gold went up enough to where if a certain percentage of your assets was gold, the bank would look at your balance sheet and they wouldn't even take the real estate. Or they may say, okay, we need you to cough up a certain amount because the value of your home is now way below the value of the loan. So we need basically more of a down payment. They need you.
Well, I mean, there's different ways you can play it. At the end of the day, to be able to control real estate, you got to be able to control it with the cash flow. And the cash flow controls the mortgage, and mortgage controls the property, and over time, inflation is your friend. It's when you lose control of the cash flow, you lose control of the mortgage. Now, when you're upside down on a property, you lose the motivation to deal with the cash flow, especially if it's coming out of your paycheck. You have a little bit of resiliency if it's a rental property, because you just keep applying those rents. But I was negative cash flow. But what I would have had the opportunity to do in this scenario is I would have been able to retire that debt after negotiating it down, because they were going to take a haircut if they foreclosed too, either way. Right.
Mm-hmm.
So if I can get them to take a haircut with me, I mean, it damages my credit score, but I would have had a chance to hold on to the properties. And if not, then they could take the properties. When you sign a mortgage, the deal is pretty straightforward. If it's non-recourse, either they get the payments or they get the property. And they agreed to it at the beginning. You walk away, hand them the keys, go, hey, take the property. That's fine. I'll buy the one across the street using the profit in my gold. And, I still end up with a property. It's just not the same one I had with the same financial structure.
Yeah. I just want to show this last one for anybody that's interested. There's from when gold, from the beginning of the century, so the year 2000. That's the performance of gold, real estate, and the S&P 500, all on one line, all indexed to 100. Okay, so I'm sort of done with these charts. You read my book recently.
I am devouring your book, Mike. Check it out. I got all this stuff highlighted. I love it. I can tell you worked with Kiyosaki because you've written in very simple language, but the concepts are very sophisticated. And I think the parts that you get right is just understanding the plumbing of the financial system and their relationship with the real world. I think a lot of people who geek out on the plumbing of the financial system forget to make the connection to the real world. A lot of people who run around in the real world, especially real estate investors, this is how I was. We don't think what goes on in the macro matters to us at all. We ignore it. The problem is, it's like having your back to the ocean when the tsunami is forming out on the horizon. If you're not watching the weather reports or don't know how to read them, you don't know you got a problem until you're swept away. That's what happened to me in 2008. So when a guy like you takes the time to write a book like this, I just recommend everybody, don't just read it. Reading it isn't good enough. You got to really study it. And so I learned a technique. My late wife and I homeschooled our children. And I say that lightly because she really did the work. But one of the things that we learned was this concept called 4Ring. And I'll share it with you because it's really served me well, especially in the wake of recovering from a difficult time when you really have to study. And the first R is read. And then when you read, you research. You're going to have terms, you're going to have things you don't understand. Don't just gloss over it, but dig in and look it up and try to figure out what it means. It's never been easier to do. And the third one is, so you read, you research, then you reason, you think about it. Like, what does this really mean? And does it make sense? Do I agree? Do I disagree? Just because somebody wrote it, just because somebody's an expert doesn't mean they're right. You know, you have to ask yourself, does this make sense? And then you relate it back to your situation, to how does this matter to me in the real world? How does this matter to people? And when you read books that way, it opens up a world, and you can take your education that you get from the book and convert it into actual action in the real world. And so I recommend all the people that we coach and talk with to study books that way. And that's what I'm doing right now with your book.
Okay, thanks. So have you, speaking about all of that, have you read The Great Taking yet?
No.
Okay.
No, I haven't.
We just released a video on that recently, and this author, he's writing it from a conspiracy theory perspective.
I'm right there. I got my tinfoil hat over here in the back in the cupboard.
So a little bit of it sounds, a little bit nutty. However, take a look at the evidence that he's put together. Do you remember when Cyprus did the bail-ins?
Sure.
That was 2012 or something like that. And right after that, shortly after that, laws were changed in the United States to allow the same thing in the next crisis in the US,
but they were passed like in 2000, whenever, but they didn't activate for like 5 years later. So the people who passed those laws in the Dodd-Frank bill, they left. And then the thing, I think it was 2014 that it actually activated. So the government likes to do that. They like to hide ticking time bombs in this legislation.
Right. Well, there have been a whole bunch of other decisions and legislation and rulings in court cases and so on that have allowed the taking of assets. And what this guy believes is that there's going to be a big deflation. Now, in 2008, we did see a deflation in some asset prices. The stock markets crashed, real estate crashed, but gold took off. And you didn't see deflation in retail prices really in 2008. And we didn't see a contraction of the currency supply. We saw an expansion of the currency supply. And he's thinking that there is going to be a genuine deflation, Great Depression style, that happens. And it's that this will be coupled with the Federal Reserve sort of manipulating this. In my first book, back then, everybody was thinking that there was going to be big inflation, that was the next step, that there's all this currency printing, it's going to lead to big inflation or even hyperinflation. And so all the analysts were screaming hyperinflation, inflation. And I'm going, it doesn't work that way. The big boys throughout history, the big boys always win. And if everybody is leveraged out on debt and you go into a hyperinflation, with just a few minutes work, you can pay off your mortgage. So it doesn't go straight into hyperinflation when the public is all on one side of the boat capsizes.
Right.
It isn't like, everybody gets rewarded for stupidity. When everybody's strung out on massive amounts of debt, that's when you go into deflation, and they can't sell an asset to pay off that debt. All of the assets are down; they're underwater on everything.
And that's what happened to me.
And that's when the banks. We had asset price deflation, and he's thinking it's going to be real deflation with not just asset prices, but the currency supply and retail prices everywhere. Right now, what we've seen, I said in the book that no, you're going to have, and in episode 6 of Hidden Secrets of Money, we're going to have, we had this dip in asset prices, deflation in asset prices in 2008. We had a reflation. We need to have an inflation and people going out on debt and leverage again, and then a big deflation, and the banks get to take everything, the big boys win. And then be able to go into big inflation or hyperinflation, the Fed has to be so scared of deflation that they print and print and print until finally deflation gives way. Finally, people feel good enough to go out and buy stuff again. And that's in episode. So what I'm seeing is that, if this guy is right, that this is what I wrote back in 2005, 6, 7, and early 2008, because my book came out just before the last the global financial crisis of 2008, and it pretty much predicted that, and it became a bestseller because of that. But I think that what this guy, when he lines up all of the evidence, even if you think from the way it's written that it might be conspiracy theory stuff, and not, maybe it doesn't play out this way, but he sure provides a lot of evidence that the game has been set up, and the people that usually win are the people that are running the game. It's the house in Las Vegas that wins, not the individual gambler. And with the lockdowns we've had, and then the big inflation afterwards, but it was an inflation where wages did not keep up. So everybody has been squeezed, and all of that currency that was sent out to people directly that helped to cause the inflation, that's been used up. I think all of the mortgage forbearance is ending. The student loan forbearance, even though they forgave a lot of student loans, the rest of them people are expected to make payments on now, along with payments on their mortgages, in a time where their wages didn't go up, or they went on to part-time work, and that hasn't kept up with all of the prices. So all their savings have gotten used up. So now they have no savings. They've got mortgages, and they've got a lot of credit card debt, student loan debt, and then you collapse everything. The banks end up with everything. And he calls it the Great Taking. And they have put laws and regulations in place that allow the brokerage houses to all of the stocks. If you've got stocks in a brokerage account and bonds, assets in a brokerage account, those assets aren't even there in that brokerage account. They have been rehypothecated. They are in a clearinghouse, an international clearinghouse, and they are not allocated and segregated. It's just pooled, and so your stock certificates. You think you've got stocks, like a stock certificate with your name on it. What you've got is a brokerage account with an IOU for that amount of stock or bonds or whatever, and that your stocks have been taken and rehypothecated, and they're in this clearinghouse. And in a crisis, that the clearinghouse, all of those stocks can be used they are the collateral for all of the derivatives market. And the derivatives keep on getting rehypothecated and rehypothecated, and that's bigger than world GDP. I mean, there is no bailout that they can possibly do. The risk just gets transferred from direct risk to derivatives risk, but it's not gone. Somebody may think they're smart because they've taken insurance out, a brokerage house. They've taken insurance out on interest rate changes. So they're hedged on interest rate changes, but it just transfers the risk to somebody else that's taken the bet in the derivatives market. And it's all backed by the collateral of the stock exchange and your home. If you've got a loan with the bank, and especially if that loan ended up inside of a mortgage-backed security, everything is at risk, and the rules have been changed so that you think you may own your house and own your stocks, but they've been changed so that the ultimate collateral holder, the one that's at the very front of the line when it comes to bankruptcy proceedings that can collect on everything, is the big boys, and they're called the protected class. That's actually what they call them. And companies like JP Morgan Chase are that protected class. It's all the primary dealers that deal with the Federal Reserve. They're all protected, and they're the ones that end up with all the cookies if we go into a big deflation. And so what I wrote back in 2005, 6, 7, and 8 really does seem to be playing out. There's little twists and stuff, and a few more little bumps in the roller coaster before we get there. And it's taking a decade longer to play out than I thought it would. But here we are. I suggest reading The Great Taking. If you go to thegreattaking.com, it's available for free on a download.
Actually, Mike, now that you mention it, this morning, a friend of mine sent me a text and said, "Hey, have you seen this documentary?" And now I remember that's what it was called. And, I agree. I mean, obviously, Creature from Jekyll Island, Ed Griffin, G. Edward Griffin, mutual friend of ours, he wrote this amazing book that just explained the Federal Reserve System. I think if people are listening to this, you really want to understand what's going on.
Yes.
Set the conspiracy theory thing aside, because it doesn't matter. It doesn't matter. Right. If you're locked in a room with an elephant and the elephant hates you, the elephant loves you, or the elephant doesn't even know you're there. If the elephant steps on you, you're dead. It doesn't make any difference. So motives are interesting, but what you have to do is really watch that elephant's movements to get some indication of whether you're in danger or not, or where to position yourself to avoid the problem. And so I think reading The Creature from Jekyll Island, very helpful. We didn't have an income tax. We didn't have an IRS. We didn't have a Federal Reserve until 1913. So the United States got along pretty good up until 1913. And when you understand how the world changed, we've been through a number of great resets. 1913 was one of them. 1933 is a year we all know real well. That's when Franklin Delano Roosevelt signed the Executive Order 6102, took everybody's gold and changed the system. Introduced the New Deal and took a lot of power and consolidated it to the federal government. And I think that if you understand that people who are in power of whatever stripe want to have more power, consolidate power, secure power, then if you look at what goes on in the world through that lens, everything they do makes sense. They might not be thieves. They might think that if they can control everything, they can make the world better, even for you. Benevolent jailers, if you will. You may not like it because you want to be free. And I think I'm obviously from that stripe. You look behind me, I'm having a love affair with Lady Liberty. I mean, that's what I'm all about, the Bill of Rights. I think our founding fathers did better than anybody in the history of Earth in creating.
I am going to use that quote, benevolent jailers, just to let you know. Okay. And I'll give you credit. So
yeah, well, if you really understand, there's an old scripture that says the borrower is servant to the lender. And if you understand that basic principle and you understand our entire system is credit, and you are more often than not either the borrower or the collateral. And you say, well, Russ, I don't go into debt. I understand you don't go into debt, but your government goes into debt for you. And then through the power to tax you. So they issue bonds, which is their ability to go into debt. And then the collateral is you and your future earnings. That's the game. And so when you understand that the system is credit, and that you are the collateral. And the one thing you will never hear anybody talk about on financial TV is counterparty risk. Nobody will ever talk about it. So if you listen to Wall Street news and pay attention to all the mainstream guys and all the people that are being supported by the advertising for the Wall Street businesses and brokerage houses, you're going to understand they will never, ever, 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 ever talk about counterparty risk, Mike, which you were talking about, where the asset you think you're holding is simultaneously somebody else's liability. And there's a reason why the ultimate insiders in currency, which are the central banks, have been loading up on gold at a faster rate than they ever did since Nixon broke the gold standard back in the 70s. There's a reason for that. And it's a clue. And I think Main Street is starting to figure it out. Did you see the article that came out the other day saying Costco selling something like $100 million a quarter in gold bars? You must have seen that.
Yeah, but they do that, and a lot of people bought, and they ran out. Well, we didn't run out as a dealer over at GoldSilver.com, and we will buy it back from you, and we can open up storage accounts at Brinks for you, and we can put it in your IRA. So Costco has it. A lot of people have taken advantage of that, and it's good if you want an ounce or two at home. They were capped at, you couldn't buy more than, it was 2 ounces per customer, and they sold out immediately.
Yeah, kind of like when you have a shortage, when there's the pandemic and everybody's trying to buy toilet paper And think
Right.
about that for a minute. My point about that, Mike, is not that Costco is the best place to buy gold. I'd argue that it isn't. And I'd even argue maybe they're not selling the best kind of gold you would want to hold, but that's a
Right.
different
It's just
discussion
that you
too.
make it that easy for the public. You put it in front of their face, and people that hadn't even thought about it before feel that there is something wrong with the economy right now, and they bought.
That's the point. That's the point. And culturally, there's a shift, right? There's people coming in from outside this country that have a different relationship to gold than Americans. And I think there's a lesson there. One of the things that I've learned is that everybody around the world thinks about money two different ways, or currency two different ways. They think about their local currency and they think about the US dollar, because the dollar is the world's reserve currency. Americans don't think
Mhm.
that way. Americans only think about the dollar. And for a long time, that was a great advantage. But today I would say it's a disadvantage. And the reason is because it makes us blind to the fact that the dollar is having issues and the rest of the world sees it. There's alliances of major countries all working together. I don't need to tell you this, to get away from the dollar. And this is a movement that's been going on for a dozen years since the GFC. And they saw how we handled that and how much the Fed's balance sheet grew. And
Mhm.
so the world is trying to get away from the dollar. I'm not saying they're going to succeed or they're going to succeed anytime soon, but they're trying. And if they were to succeed, and I think you need to be prepared for that as a possibility, you better have a plan. Because if your whole life is denominated in dollars, if you earn dollars, you borrow dollars, you invest in dollars, you think about value in terms of dollars, and the dollar changes, what are you going to do? If you don't understand
Right.
counterparty risk and you don't understand currency risk and you're an investor out there like I was, this is how I was in 2008, and I didn't understand credit markets. Those are three things that you really need to understand. And when you understand them, then you can look at what the big boys are doing, Mike, to your point, and
Right.
begin to recognize where the threats and where the opportunities are going to be and get repositioned. So it's an exciting time now because there's so much chaos and I feel better educated, but even more than being educated, I'm excited because I'm connected to people like you, people like George Gammon, Kenny McElroy, these people I get to hang out with that really play the game at a high level, that understand things, and we can have these types of conversations. So I'm delighted that you decided to have this conversation with me and that we get a chance to talk with your audience. So thank you for having me.
Yeah, you just mentioned the big boys, and the biggest of the big boys are the central banks. And you were saying that people that aren't Americans think about their currency and they think about the U.S. dollar. The other central banks around the world, though, think about the U.S. dollar and gold. They do think about gold. They're accumulating gold, and the reason is no counterparty risk. The dollars have an enormous counterparty risk for all of the world's central banks, and that is the reason they're accumulating gold. Is that lack of counterparty risk? It's there. It doesn't vanish. Dollars spring into existence and vanish every day. That's the reason I call them currency, is because, according to Aristotle and every legitimate economist since then, uh, the key functions are a medium of exchange, a unit of account, and a store of value. How can it be a store of value if it comes into existence like repurchase agreements that the Federal Reserve does? They type dollars into existence and buy $1 billion worth of treasuries from a bank. And so those dollars sprung into existence, and it's $1 billion worth. And then the next day, the agreement says that the bank is going to buy back the U.S. Treasury for $1 billion plus a little bit of interest, and those dollars vanish when they hit the Fed's balance sheet. They're gone. And so they only stored value for one day and then they're gone. And so it's currency. It's gold doesn't vanish. And so I really got to thank you, Russ. This was a tremendous interview, and your insights from going through this yourself. You learned from the bad times, just like Donald Trump said. That's when you really learn. Do you have anything else to add about your personal experience and what this adds up to and what you look forward to in the future?
Well, I think that if I could talk with people out there, is just preaching to the choir a little bit. Your audience is already kind of sold on gold, but I think one
Uh-huh.
of the mistakes a lot of gold investors make is they think of it as an investment. Number one, and I don't. It's money, savings, and you make investments which generate cash flow. Something I learned from Robert Kiyosaki. The second thing is they use gold as a trading vehicle. And if you really think about the illogic of that, I hate paper currency, therefore I'm going to buy gold cheap and sell it high and end up with what? A whole
More
bunch of
paper
paper
currency.
currency, right? So that's not a good game. So you have to really test and say, what am I really thinking? And if you denominate your wealth in ounces, then you get excited when the price goes down in dollars because it means it's on sale and you can collect more, and it changes your whole paradigm. So I think that continue to accumulate gold for sure, and understand though what it is and what the dollar is and isn't. And the other thing that I think that many people don't put enough emphasis on is not just their education, but their what I call advisory board. So I have a 6B thing that I do. I have 6Bs that I evaluate myself on every week. And the first B is my brain. Did I put good ideas in my brain? Number 2, my body. Did I put good food? Did I take care of my body? Number 3, my brand. Did I behave in a way that people think better of me or worse? Number 4 is my board, my advisory board. Who are the smart people that I've added? Who are the smart people I've spent time with? Who are the smart people that I'm allowing to speak into my life and to give me new ideas that I'm willing to be humble in front of and take my problems to? If you don't have those people in your life, then one of the best goals you could make for 2024 as we approach this new year is to make a strategic plan to get in relationships with the highest caliber people you can possibly spend time with, and then budget time and money to spend time with them. Study books, listen to podcasts, go to seminars, socialize with them, and just chit chat about what's going on in the world. But make a commitment to do it. We are going to need each other more than ever before. The pace of change, the radical shifts that are going to occur as this, financial car is fishtailing across the ice. It's a slippery slope. To mix a whole bunch of metaphors. I think we're going to really need each other. So I encourage people to do that. Invest in your education, invest in your time, change your paradigm about gold. And then I think that don't get too hung up in the motives of the big guys. They're going to do what they're going to do. They're not calling Mike. They're not calling me. They don't care. Maybe our vote counts. Maybe it doesn't. I don't know. You should still vote. But at the end of the day, you vote with your pocketbook, and you can opt out of their system by getting out of the banking system, by getting out of the credit system, by having no counterparty risk on a major chunk of your wealth storage, which would be gold. And so don't worry
Yeah.
about the price, just collect ounces. And the more you have, the happier you're going to be, in my opinion. Not giving you financial advice. I'm just telling you, if I could go back in time, if I would have done this, it'd be a lot different.
I'm also keeping a lot of cash, the paper Federal Reserve notes. So gold, silver, and cash, because the cash can't vanish. And in a deflation, it's gaining in value. It's gaining in purchasing power.
And bullets.
And bullets, right.
Great
Robert
barter
teaches
commodity. I'm telling you, if the world goes to, you're going to be, I'll trade you, a box of 9mm for a steak.
I'm going to buy more bullets then. Robert teaches the 5 Gs, that what you really want is ground, grub, gas, guns, and gold.
Yep.
If you've got the 5 Gs, you're doing well. So Russ, what was the best thing that you learned in the Bahamas when we were there for the collective?
I would say that smart people can look at the same situation through a different set of eyes. Brent Johnson was there, brilliant guy, and George Gammon, who I just think is amazing. And Brent has his dollar milkshake theory, and he's not really concerned about dollar weakness. In fact, makes the argument that the dollar is strong. And I have respect for both those guys. And from their perspective, they're right. It is strong when you compare it to the DXY, right? The other 6 currencies or whatever it is in that index. And the way I explained it in the Bahamas was that if you got a bunch of people that all jump out of a airplane together and they're pegged, they're holding hands, they're going to fall equally. But if one person pulls their chute first, in this case, raises interest rates first, whoosh, their currency goes way up. And they look like they're going up relative to everybody else who's falling faster. But the barometer of movement isn't each other because you're all falling. It's the ground, and the ground is solid. It does not move. And so when you look at the dollar against the barometer of gold, which does not move, you realize that the dollar is weak. The dollar is weak against gold. It's weak against real estate. It's weak against the things that are real. And so it doesn't make Brent and George wrong. They're right because they're in the game of investing for dollars in paper asset markets. Maybe not George so much, but Brent. But I can see both sides of it. And so I think what I learned is that it's okay for me to disagree or have a different perspective than even really smart people. And so I encourage people, when you're out there and you're having the conversations, don't just assume because somebody has a podcast or wrote a book that they're smarter than you are. You're probably smarter than you realize. So just trust your own judgment. So for me, that was a fun takeaway. And I think somebody told me that George actually quoted that explanation of jumping out of the airplane on one of his podcasts and gave me a shout. So that was pretty cool.
Yeah. Gold has lost the dollar has lost 99% of its value against gold since Roosevelt took us off of, gold used to be, the dollar used to be worth 1/20th of an ounce of gold. Now it is worth 1/2000th of an ounce of gold. So Russ, where can people find you? What's your website? And
well, I'll tell you, I appreciate that, Mike. You've inspired me. I've been reading your book. I'm gonna promote it one more time, folks. If you've not read this book, read it. And like I said, study it. And so I decided I wanted to write a book, and I am going to title it Gold Wealth. My working title is Gold, Real Estate, and Real Wealth. And to share the things that I've learned about putting the two together and what I wish I would have known in 2008. So if folks want to get on the advanced notice list and maybe even be part of my guinea pig group that I float ideas to, just send an email to gold@russellgray.com. Gold@russellgray.com. I'll put you on the list, and when the book's out, I'll let you know.
Thanks, Russ. It's been great having you. Is there any last thing you want to say?
Guys, just keep listening to the great Mike Maloney. Mike, thank you so much for your work. You have changed so many lives. You've inspired so many people, including me. Now I get to go write a book. I hope I don't have to work as hard on it as you did, but I hope it's popular. And when it's done, I'll send you an advanced copy. Maybe if you like it, you can give me a little endorsement.
Okay. Thanks a lot. And we'll see you next time.
Thank you.